Okay, here we are. Earnings season has begun. Not very much information so far, but we had a horrific issue by Netflix. It's kicked us off to a bad start on the tech side. Although honestly, I mean, we're no worse off than we were last week. If we look at these charts, let's go daily. Hourly, sorry, hourly's better. So last week was, this was Wednesday last week, and we were, well, in the afternoon on Wednesday we were here, and now we're here. It's not very much of a difference for the Russell. On the Nasdaq, we were probably a little bit lower. Yep. So webinar time, we were here, and now we're here. Not a big variation. So I mean, you know, so the short story is here's the S&P. Also, they've all moved up about one box basically, and the Dow's gone flying. The Dow was here 344, and now it's 352 almost. That's like, well, that's 800 points. That's the 800 points we gained in the last 2 days basically. So you know, obviously we could lose it just as quickly, but you know, I wouldn't say there's a trend. Nothing's building up. There's no particular thing. Oil has been interesting because oil all of a sudden, well, back to where it was last week. Last week we were at 103. Now we're back at 101. So not much going on there. Gasoline hasn't moved. And that's what, by the way, that's what this is useful for. These when we do the bounce line charts, that's what they're useful for, because you look at them from week to week and you say, hey, nothing changed. That's the point of the ranges, though. You have to understand that movement within the ranges is meaningless. So until you start actually changing the colors, it doesn't matter what the number is. It doesn't matter how far in between things go. Now, the S&P, still not at 4,500. The Nasdaq is obviously went lower. That's no help. The Russell isn't going high enough to make a difference. And the Dow is below 30. I'm sorry, no, the Dow did turn. The Dow was on the cusp over here this morning. So the Dow is now turned green. So on the whole, for the day, we've gained one green box. That's our change for the day. And that box was halfway changed yesterday anyway. That's how you watch the market and decide that there's nothing worth doing. Don't get caught up staring at these individual numbers and every day this and that. Oh, it's up. Oh, it's down. Blah, blah, blah. It doesn't matter because the chart hasn't really changed since last week. And that's all that matters, is if you start seeing a trend that says we're moving out of this, we're in this range currently. And to move out of it, you're going to have to see all of it. You'll have to see a sea of green washing over. You have to see these guys go green, green, green. Then you'll have to see a couple of these go green. And then you say, oh, I guess we're moving up to the higher range. Now, in this case, the higher range, because these are the numbers off our all-time highs, 36,000, 4,700, 16,500, and 2,400. The higher range would be breaking up to new highs. I just can't see why we would do that. It doesn't make sense. When we were at these new highs in December, January, basically last year, or this year, whatever you call it. Well, basically, if you count the Russell, excuse me, I think everyone peaked out before the beginning of the year. So Q4 is when we peaked out. Let's put it that way. And so why would we get back to the Q4 highs? We have a year of Fed rate hikes ahead of us, without question. We have the highest inflation we've had in 40 years, rocking everything. We have a really expensive housing market, really expensive rates, all part of the inflation thing, of course. But it's slowing down the housing industry, which is a tremendously large part of our entire GDP. We have record high consumer debt, record high corporate debt, and we have a war. All these are the changes from last quarter. What's been better? I really can't think of anything, so tell me what's better. Climate change not improving. I don't know. I don't know what's improving. And you see these polls, and the polls are a little bullshitty, but you know, as low as 1/3 of the people approve of Biden, which is terrible. It's definitely not 50%. It's like 40% to 33% is the range they're looking at. And those are terrible numbers. A very large portion of the people in the country think the country's heading in the wrong direction. What is the stock market so happy about? You know, and you know, as usual, there is to some extent the problem that there's nowhere else to put your money. You're not going to put your money in the housing market. The commodities are incredibly overpriced. Rich people are still getting richer and richer and richer, and that's never going to stop because I guess I don't like to. I make a terrible teacher. I don't like to say. I never like to say the same thing twice. I will say this, though, this is an important concept, okay? Because it's really, where can I write? Look, Elon Musk has $300 billion. I mean, it looks like this. That's what $300 billion looks like. That's insane. That's why when he says I'll buy Twitter for, you know, for $40 billion, it's like, well, he could. Now, of course, those assets of Elon's are tied up mostly in Tesla stock. He's probably about 200 billion of it is Tesla stock, so it's not that liquid. And then there's the valuation of Spacex that's his also. A big portion of that is his. You know, it's not like he's liquid $300 billion. Bill Gates is pretty much liquid, whatever he's got, $150 billion or something like that. That's what Bill Gates has sitting in the bank. He can sell, he's got nothing he can't cash in. But Elon is still tied up. And then, you know, Gates used to be tied up in Microsoft. You extract yourself at some point. Buffett's 150 billion. That's a good amount in Berkshire Hathaway. So, you know, not that liquid, but you know, I think he could probably wiggle his way out of it. But anyway, so when somebody's this rich, or actually it's probably down to 200 billion now, right? Because Tesla's taken a bath recently. Let's see. That's funny how you can lose $100 billion, Tesla. Oh no, it's not that bad. All right, so he's 20% off his highs on Tesla, so it's probably still up there. I know he peaked out at 300 though. So where were we? We were calculating. Okay, so here's the thing about having $300 billion though. If you get 5% interest times 0.05, that's $15 billion a year of interest on the money. That's without growth and without doing anything with it. That's just getting 5% interest. And he will get $15 billion richer than he is. There aren't many people in the world who have $15 billion. He'll get $15 billion richer just putting his money that he has now in the bank. And that's the problem with these vast pools of wealth, is they have to grow. They have to grow, right? Otherwise, what's the point of money managers? What's the point of anything? You don't have $300 billion and be satisfied that you're only making 5%. You're certainly not making 2% in the bank. You know, you need to get 30, you know, to be happy, quote happy, you need to be $30 billion richer next year. And believe me, Elon Musk didn't get to 300 billion by being happy and getting 10% richer each year. You know, he's scheming and plotting and figuring out ways. And the problem is, as you get this rich, right? Even what he did with Tesla, he accumulated 20% of Tesla's stock. He announced 10, and while he was announcing 10, he had another 10. Twitter. All right, so he's buying Twitter stock. He announces he bought Twitter stock. It goes flying up. He announced that he had bought 10% while he was buying 10% more over here. it goes up to 45 permanently. He made 10% on his entire purchase. Twitter's total value is, I want to say 100 billion, but I could be wrong. It's like maybe 50 billion. Oh, 40 billion, way lower than I thought. Okay. So Twitter's 40 billion. So in other words, Elon Musk is accumulating $8 billion worth of Twitter stock. Oh, that's not it. So he buys 4 billion and another 4 billion of Twitter stock. Okay. He announces it here. But he announces a 10% threshold he crossed. That's the SEC reg. When he announced when you cross the 30-day the 10% threshold, you have a certain amount of days to announce that you've accumulated stock. So of course, while he's in the waiting period, he's accumulating more stock because he knows his announcement will trigger a rise in the stock. Then he makes an offer on top of that to guarantee that people rush in. Look at the volume difference, okay? People rush in to buy the stock, and he's selling it, and he sells it, and meanwhile he has a fight with the board on purpose to excuse his sale of the stock that he just announced that he bought, and he makes 10%. Those are the kind of games you can play when you're that rich. So he buys $8 billion worth of stock. He makes 10%. He makes $1 billion. Okay, so what? He needs to make 30 billion this year to do that. He needs to do that once a month. And that's only going to make him $12 billion. This is the problem. People get this rich and they've got to do monumental things in order to get richer. You know, Buffett has the same problem at Berkshire. The big hedge funds have this problem. The large capital management companies that have hundreds of billions of dollars. What do you do to move the needle at a certain point? So you have to engineer movement in the market. You can't just put money into a dividend stock and get 5%. Nobody's going to accept that. You've got to engineer a crisis. You've got to engineer growth. And when you can't engineer growth, you've got to engineer a collapse in order for you to make a meaningful amount of money. So, you know, don't think that these people aren't crashing the stock market every once in a while, because you have to crash the market so you have something to buy. You know, they got to pump things up, and then they got to pull the plug and drop it down. And they go in and out. Same thing with real estate. They tell you everybody's buying this, everybody's buying that, and send everybody over to certain kind of properties and so on and so forth. And then they get out and they sell at the top, and then they go and start the next ride somewhere else. It becomes this beast that you have to feed. And when you know, we've never had before a problem where individual people at this level are like this. And Elon Musk isn't like Warren Buffett. Warren Buffett and Bill Gates is another one. Bill Gates gave more money to charity than he currently has. Warren Buffett too, frankly. And Warren Buffett's pledged all his money to charity when he dies, and so is Bill Gates. You know, these guys aren't accumulating disastrous amounts of wealth. They're giving it away on a regular basis. Elon Musk doesn't give anything away. He's accumulating. Bezos too. Bezos doesn't give away meaningful amounts of money. He's accumulating. So these guys who just want more and more and grow and compete with each other for who's got the most money and so on and so forth, who's ranked number one this month, they're like black holes of money. The mass of the money that these people have sucks up all the other money. And it's not a zero-sum game, because, well, it is a zero-sum game. They are losers. You know, they are winners, but somebody's losing. And it's not that you're not being personally affected, because that money that's going to them would otherwise go into the economy and benefit everybody and other people. But instead, it's going into their personal fortunes. You know, their money demands interest payment. Their money demands higher prices. Their money is, it was, I think it was Blackstone or BlackRock, one of those companies, but they bought, they just took a stake in the biggest student apartment company. So in other words, for college students now, they put $14 billion into student housing, because student housing rents have not kept up with private rents, and therefore they're like, well, that's got to stop. So in other words, they get their legal teams on it, and they get their PR people on it, and they get their spin doctors on it, and they figure out how they're going to change the rules and work the framework and do whatever and pump up the price of student rents. That's not beneficial to anybody. You know, that's detrimental to society for sure. There's nothing positive about what they're doing. And it's only happening because these, again, it goes back, it's all a function of they've got to feed the beast. Okay, people like Elon Musk and Jeff Bezos and whoever, they invest their money in these companies and say, go find some way to make us 10 and 15% on incredible amounts of money. So they've got to look under every rock and get into every nook and cranny of society and squeeze out a maximum profit. Okay. Cleaning services is another place. Okay. Used to be you could hire a maid and she would come and clean your place for like $50, right? And would come by and make $50 and whatever and pocket it. Okay. Now, I have maids, they still come by and they make $50. They make the same $50 they always make, except now they work for a cleaning company that makes another $50. So it costs me $100 to clean the same apartment with the same woman who makes the same $50, but now some freaking corporation is involved in the process. And you can't find anybody who isn't working for them. Why? Because the corporations offer the maids a steady clientele. The maids don't have to find their own business, blah, blah, blah. You know, yes, are there benefits to the maids? Yeah, of course. They're more booked up more often. So she makes her $50 an hour for me, but she's more likely to have 3 jobs a day than before. Maybe she had 2 jobs a day. So on the whole, it works out better for her. It doesn't really work out better for her because she probably hasn't, because 10 years ago she made $50 for me. Now she makes $50 for me because the maid service is taking all the extra money. But they don't do shit and they make $50. And everything's like that. Think about how many different things in your life are like that, where some corporation has inserted itself into a process that used to be pretty normal. And they're not there for your benefit. They could say they're there for your benefit, but they're there to extract the most amount of money possible from you. Okay? Even like you think about even stores, gas stations, that's chain stores and things like that. It used to be that you would have a local hardware store, and the local hardware store would sell you stuff, and they would charge whatever, and you know, you got your goods at the hardware store when you need it. Now we go to Home Depot. Home Depot is just another hardware store, but it's much bigger, and it's got but Home Depot now, we're paying for this huge management company that you know, we're paying for this huge management company that sucks all the money away from the town. See, when you used to give your money to the hardware guy down the street, he lived in the town. He would spend the money at the local stores and so on and so forth and support the local industry. Home Depot doesn't do that. Home Depot doesn't live in your town. They employ people in your town, but so does your local hardware store. So that's all bullshit when they say things like that. Walmart too. Walmart's really good at that. Oh, we employ so many people. It's like, yeah, but those people used to have jobs. They used to have jobs for more money in other places. They used to work for all the stores you shut down. So they're not doing you any favors, and what they're really doing is they're taking all the profit that used to stay in your town and they're taking it away to their headquarters. And they're distributing it among the shareholders, who are these rich sons of bitches. The same multi-billionaires have the shares of the stock, and they're basically extracting the money. This is how they get their money. That's why it's a black hole. It's a gigantic suck of money away from you, away from your community, and towards just a very, very few people sitting at the very top. And you know, and then when you reach the logical conclusion that, well, these people should then pay more taxes to balance things out a bit, oh my God, everybody loses their shit. And again, it goes back to the fact that people don't understand the math of the thing. But the math of the thing is insane. Okay, Elon Musk at 5% needs 15 billion a year. At 10%, 30 billion a year. $30 billion a year. So let's say 30 billion. That's only million. There we go. Divided by 165 million working people is $200 a person. So Elon Musk is taking $200 from you in order for him to make his interest, not even his profits, his interest for the year. He needs $200 from you, but so does Bill Gates, and so does Jeff Bezos, and so does this, and so does that. So before you know it, you're spending thousands of dollars supporting the billionaire class and their constant thirst for money in little teeny tiny ways, and none of them you really complain about, like the maid service or like the Starbucks and the money that leaves the town. And you don't realize that it's one less person visiting your business. It's one less person who can come to you with some money. It's one more person you've got to put some money into their pocket. It's 1,000 little cuts. But those 1,000 little cuts are all going to one place. They're going to these top multi-billionaire people who are sucking all the money out of the entire planet. And the inequality is getting worse and worse and worse, and the middle class is disintegrating. Because don't forget, when I say it's $181 a person, it's not really $181 a person, because you know the bottom 50% people don't have the money to give to Elon Musk. It's not there. So he goes, well, somebody's got to give me this money. I'm not going to excuse these people. So now you double it, because only the top 50% are paying the money to Elon Musk. I mean, everybody's paying it somehow. In all the ways things are more expensive, those people who live in the bottom 50%, they've got to pay more for a landlord, because now the landlord, instead of being some guy, again, who lives in the community, who puts the money back in the community, no. Now it's some gigantic corporation that has teams of lawyers to make sure that every single renter gets screwed in any complaint that they make, because instead of just calling a landlord and sorting it out yourself, you have to call the company and fill out Form XYZ and do this and that and talk to and then the legal team sends you back a thing denying all your claim requests, blah, blah, blah. You know, same thing. Insurance also same way. Hospitals, health insurance. Every little way that they can nickel and dime you, it's being done. All right. Now, so defensively, fortunately for us, and I imagine almost everybody listening here, we are the investing class. We get to participate in this bullshit, and we get to own the companies. But where do we start this conversation? Because stocks are holding up. Why are stocks holding up? Because they're the ultimate beneficiary of all this stuff. At the moment, for now, we get to invest along with Elon Musk, and we get to invest along with Buffett and Gates and so on and so forth, and we get to buy these companies that are screwing people and raising the rents and charging extra and nickel and diming everybody and lowering wages and putting regular stores out of business. That's what we get to buy. All right, I morally object to it, but logically, you just have to play the game, basically. So the positive that I see for the market is that this game is afoot, and it's continuing, and it's getting worse and worse for the bottom people, and the corporations are getting better and better at squeezing profits. And you know, it's funny because the main use of artificial intelligence right now is not how to make a better widget, not how to improve products, not how to how to make better distribution. It's how to make more money. Every company has these AI systems running and looking at their operations, because it's easier to do with data, and say, where are we not producing? Where are we underperforming? Where can we squeeze more profits? And that's something these computers are pretty good at. And in fact, AI is what led to housing squeeze that we're in now, because AI was telling a bunch of very wealthy investors that here's a place we could put billions and billions of dollars to work, where we have certain areas in the country that are statistically undervalued, and therefore let's buy those. Now, the inefficiency of the housing market is a benefit to the people buying housing, because they're on the ground and they benefit from some areas cheap and some areas this. What they're going to do, and what they are doing very quickly and very efficiently in a surprising manner, is they're making it so there are no cheap places. Nothing is statistically cheap anymore, because anything that's statistically cheap, anything that's 5% a better deal than somewhere else, they're buying it and taking it off the market and flipping it and turning it into a more expensive property. If a landlord is a nice guy and has kept his rents fairly low because his expenses are fairly low and he's making himself a couple $100,000 a year, right? So let's say there's a landlord in a building. He's owned the building's family for generations. It's totally paid off. He makes $250,000 a year and he's happy. He makes a good amount of money. He's got an apartment in his building. He's a good guy. Takes care of his tenants. Everybody loves him. Happy building with rents that are significantly below the market, the local market. Well, what happens? These guys jump on that. These guys see that number. It's like a big red circle on Zillow, and it shows that this building is valued much lower than the rest of the market. Why is it valued much lower? Because the rent rolls. Now, because of course at some point the landlord gets, as soon as the landlord gets a loan or anything, he ends up on the map, right? As soon as his property is valued, he gets put on the map, and his rents are suddenly public and everybody knows it. So it's very hard to keep your data completely private. So all of a sudden, this big red circle pops up on the map, and the AI jumps on it, analyzes it, and says, "Uh-oh, this guy's building is trading at $4 million, and it could be $6 million if we raise all the rents to the market levels." And so the company comes in and offers a guy $5 million cash, and he just has his building valued at $4 million, but it's valued at $4 million because renters aren't paying as much as they could be. And so these guys are offering $5 million. They flip the renters out. They force all the renters out, turn the rents up higher, and they flip the building at $6 million. And what's actually happened? 200 people who used to live in a building no longer have cheap rent. That's what happened. The entire community no longer has cheap rent, and now the entire rental averages of the community goes higher. And that's what's going on with these college housing too. College housing is all over the place. All right, but that's because there's always been a sort of a thing where you like, well, these are kids, we're not like looking to screw these people out of the last penny. They're kids scraping their money together who are already being jammed up by ridiculous tuition costs. So a lot of landlords, they aren't the mindset to maximize their rents to the students. But again, now they're getting snapped up by these corporations that are taking advantage, I don't want to say taking advantage, but they see a low price. Whenever a low price pops up on their scans, they jump in and eliminate it. They're eliminating all the low price buildings. All the low price housing units are being taken off the market. They are, because to the companies that could be making this money, they're incorrectly priced units. And they want to correctly price the units so that they can squeeze maximum profit out of them. And the thing is, these companies, because they're backed by these billionaires, have infinite amounts of money to spend. They can make cash offers and grab properties, and it's very hard to turn them down. What's the profile of these landlords? They're generally going to be older people who've owned the property for a long time, blah, blah, blah. And who doesn't want $5 million bucks? If they're going to offer you 20% above what your building was last appraised at or whatever, and you're like, okay, well, this is enough money to retire on, and so on and so forth. They take care of everything for you, and you're done. But who gets screwed is the people who are living there and who will live there in the future. And it's being done with everything. It's a different mindset than we used to have. You know, every newspaper, every French fry, every burger, every chicken nugget, every thing, every bar of soap, everything is priced up to the maximum you'll pay. Their models now are looking to say, what can we charge people? And that's also driving inflation. It's the new way they model things now, is to say, what is the maximum profit we can derive from the consumers? Nobody asked the consumers how they feel about it. Nobody gave us an AI to say what's the minimum we can spend on everything. In theory, now, the web was supposed to be that when it started. It was supposed to be this great place where you exchange ideas and so on and so forth. But what happened? All bullshit, right? Never really lived up to its plans. You know, if I want to fly, I got to go to Vegas. So I say New York, Las Vegas. Okay. Reservations.com. See, immediately, here's the thing. Companies jump in. We're reservations.com. New York Hotel Guest Reservations.com. MGM Resorts, well, that's okay. That's the ad. Now, there's a company I actually might want to talk to. Hotels.com. Orbitz.com. Groupon.com. TripAdvisor.com. All these aggregating companies have stepped in to take over the business. They've got to get their share now. Now I've got to make them money. You know, we just looked yesterday at investing in Trivago as another travel company. You know, these travel companies are the ones you can't find. You can't use the internet for what it's intended for. I'm not finding the best prices on hotels. I'm finding a bunch of travel companies. Now, what's Google telling me? Look at Google. Google and Google now is involved in this shit. All right, so let's say May. When do they want me to go to this thing? It's the 14th. I don't want to fly out during the week. What if I leave on Friday and go back on that day? Then I'll be there for the week. So then I'll be there. So here I can actually relax and have fun, play some poker. Then I work. Got to get up at 3 in the morning to do my job. But then I have the evenings free, which is nice actually when I'm out west. So the conference starts on the 12th. So I get a few days where I can acclimate myself and whatever. I speak on the 14th and I'll just leave the next day. 9 nights if I do it that way though. And no, that's not bad. Oh no, these are the hotels. I thought it was in the airfare. I was like, wow, that's pretty good for airfare. So yeah, so then they're showing the hotels, but I guarantee you the $200 hotel isn't any kind of. Oh well, New York's a decent hotel. Hotels.com, Priceline, Expedia. Huh. Mm-hmm. It's in New York. New York seems to be the cheapest one. Ooh, the Stratosphere. I like it as a concept, but it's kind of far up the strip. MGM, the Palms, Planet Hollywood, Quarter. So they're all about the same price, it turns out. The Link, can't go to Caesars anymore. That's gotten really expensive. Ooh, Luxor, $150. Good job, Luxor. You know, the Luxor last year was $25. It was Mandalay Bay. Oh, 280. That's not Trump. I wonder how he's doing. Yeah, Seasons 489. See, I used to always stay at Seasons, but they got crazy. That's a lot of money. Anywho, so whatever the airfare is. But the point is that you get aggregators. So in other words, there's always somebody stepping in, and always somebody getting in the way, and always somebody taking in between. You know, even for the airfares, there's people in between, but I usually just call American Express anyway and try to get that done directly. So, what was I saying? Oh yeah. So, you know, everything you try to do and by the way, notice the similarities of all the prices, right? And that's the thing. There used to be prices that were all over the place, and everybody would make their own price decisions. But because of the aggregators, everybody prices around what everybody else is pricing. And it's not being fixed in your favor. Everybody can go down. See, Luxor and Rio used to be the two cheapest hotels on the Strip. I'm sure they still are. But now they're 150 instead of 200 or 225. But it used to be $75 or $50 instead of $200. You know, they used to be much, much cheaper. But the thing is, when they aggregate the prices, they push more business into the hotels that are the cheapest. They bring the average price up. And there's no more discounting deals for the consumers. So that's what's happening all over the place. I mean, it's very unfortunate. And restaurant pricing too has gotten much, much higher. So, you know, it's what the market will bear is the new watchword for these things. And yeah, how's the market doing? All right, holding up very well. Look at the Dow, 300 points, amazing. And the Nasdaq is down 150. So good balance. And this morning we talked about changing our hedges a little bit. We didn't really do much in the end because we have so many hedges, especially for a market that's not going down. But we looked at the short-term portfolio. We have our longs, and we sold 23, 35, 45, and 10, 50, over $50,000 worth of short puts to offset, you know, the losses we will obviously get if they go higher. This is a meaningless play at this point because it's a balance of 2024 versus 2023. So we're just looking for this to evaporate faster than that. Chevron we shorted. They're so far still at they're at a 170 target, so nothing to complain about here. DIA, was that one we changed? The DIAs we changed, and we rolled to a much higher strike. Okay, so 350 is now our base, and we rolled to a much higher spread on the DIA. SQQ, the January 6th calls are up 50%. Let's buy them back. So the SQQ, we had 200 spread here and a 100, 150 spread here. So we have 50 more short calls than we do longs. So since the short calls, especially this morning before the Nasdaq crashed again, we picked up 44%. Since they're up that much, it made sense to buy those back. So now we no longer have that imbalance. So we moved a little bit more bearish there. So looking for a thing. Tesla, we didn't touch. There's nothing to do there. And oop, that wasn't smart. And then TZA, which is our main hedge right now, and as we saw before, in case you missed it, the Russell is of the indexes is the poorest performing. Well, especially on a weekly, you can see that. So the Russell is the poorest performing index. Now, in a rally, you might say, well, they're going to catch up the most. And that's possibly true, but oh, because we weren't going to look at that. So what we have on TZA is this is 400 longs, and they're not combined, but they're the same. The 202 425s. We have 400 shorts, and then we have 75, 50 short 40s, 50 short Julys, and 25 extra short Januaries. What we've been doing is working these off. We had a whole bunch extra. We've been working off by moving, let's say, 25 at a time to 50 of the front months and working it down that way. And I'm confident that's going to be fine, so I'm not worried about that. So effectively, we have a 400 spread here, and we have two 100 spreads here. And our adjustment was to buy back 100 of the 202 340s. So yeah, it was these. So we're buying back this 100. That leaves us with 200 long and 100 short, and the shorts are 2024. But what that allows us to do is then sell at, not now, because we're waiting for a pop, of course, because right now everything went up. But when TZA does pop next, where is it? There. So next time TZA has a pop, then we'll sell some more short calls for like July or something like that. Those will expire faster, and we'll get to do more sales and more premium in time. It won't hurt us it won't hurt us first of all because we don't have really any kind of overhang here. But if we sell 100 at a time and we get $4 for them, that's $40,000 a quarter. Just dropping into our pocket extra income. We can keep doing that. We will keep doing that forever, because as these longs get old, we put a little bit more money back into them and roll them to longer term options. So in other words, these $20 calls are $13. These $25 calls are $14. So for basically only $1 or so, it's going to cost us to buy another year of time in which we get to sell more short calls. Obviously, we're going to sell a lot more than $1 worth of short calls. So we'll just keep rolling and rolling and doing it. That's why these hedges, when you set them up, is the most expensive part of it. But once you set them up, maintaining them is actually not very expensive at all. It's just maintenance on the portfolio. And little moves like we're doing here are maintenance moves. You know, we make a little, we spend a little here, we sell a little bit here, make some money, put some money in, take some money out. But what we're doing is constantly just like pruning. It's like just improving our position a little bit by a little bit and making little incremental changes depending on what we think the market's going to do. But on the whole here, we're balanced. We're not taking, most importantly, we don't have any risk. We don't have any extra exposure. If the market suddenly drops, we don't have anything that's going to bite us in the ass. And we don't want that, because that's our biggest fear right now. It's still the biggest fear we have is an escalation of the war that sends the market down, limit down like 10% when we wake up on a Monday. That could happen anytime. It could happen in the middle of the week. It doesn't have to happen on a weekend. But at any given time, there could be some major escalation of the war. And all of a sudden, we're looking at World War III, and the market's going to go down significantly. You know, if you're not ready for that, look at Netflix today. If you're not ready for that, if you're not ready to see your stock drop 25, 30% in one day, then what are you going to do when it happens? You know, and you could say, "Oh, that'll never happen," but look at Netflix today. All that was a miss of subscriber growth. And that's what happened. There's a lot of stocks that are like that. Now, for the most part, we stay out of those stocks. We don't have a lot of the kind of high multiple stocks. And with Netflix in the long-term portfolio, where to go? So, you know, in the long-term portfolio, we had sold Netflix puts because we weren't expecting it to fall that hard. These guys, but they're down now $38,000. Okay, we sold the 350 puts for $50, more than $50. But so we were netting under $300 for Netflix, and we were like, "Oh, that should hold up. That should be a floor." Guess what? They're now $225, $75 below what we thought it would be. You know, fortunately, it was only 5, and we'll be able to roll and adjust down the road. It's not a big deal, other than the paper loss of $38,000 is very annoying. But over time, we'll work our way out of it. But that's what I was saying about the short puts being dangerous. What if that happens with the whole thing? Then you've got to take the loss. If the whole portfolio at one time drops like that, then you've got margin issues. And then you're forced to take your losses. And that's why it's so critical that you have the ability to put more cash in if you need to. And that's what the short-term portfolio is for. That's what our hedges are for, is to pay us off in a catastrophe. And in that short-term portfolio, we've got about $1.7 million worth of hedges. So if everything falls to crap, we'll have $2 million in our hedging portfolio almost entirely in cash. So currently our two portfolios together are worth $3 million. The long-term portfolio is almost all of it at 2.4 or 2.3 now. So 2.3 for the long-term portfolio. As long as we can keep this from dropping below $1 million, then if we have 2 million in the short-term portfolio and 1 million in the long-term portfolio, we have the same amount of money, just moved. And not only that though, but the thing about that is if we can maintain a balance in the short and long-term portfolios of roughly $3 million, okay, if we maintain that balance, then, and the market drops 20, 30%, then we've got $3 million to buy stocks at a 20 to 30% discount with. That's the beauty of this thing. And effectively, the strategy forces us to have cash to buy stock when the market goes down. So what's this, 2.33, and short term, let's see, 233, and short term is at 517, nasty. 517. What? Oh, I didn't put the zeros. 517, 1, 2, 3. 2.85. So we're down $150,000 from the last review. Okay, obviously 50,000 of it is coming from the Netflix, but otherwise we're down about $100,000 fluctuation from the last review where we were just a teeny bit over $3 million. And that was a week ago. You know, now of course, when you have $3 million, that's normal fluctuation in your portfolio. It's not going to worry about it, but you know, we still want to say, hey, we lost $100,000. Where did we lose it? What didn't do well in this past week or so? You know, and we're going to look at it in a month and figure it out. But obviously, Netflix, the hedges are not popping so far. You know, and of course, you know, the hedges went the other way. The hedges went down, but the long-term portfolio didn't pop. And part of that reason is because the long-term portfolio is hampered by Netflix. But what else didn't pop? And this is the problem with earnings season, right? Now we got to see who can perform and who can't perform. We have, I think we have Vail in here, right? Vail just had not so good results. So Vail came down, Vail, well, they're not down much, but 22. We have Rio somewhere, I think, yep, there's Rio. Rio also had bad results today. Nothing, you know, nothing that makes you want to dump out of the position, but disappointments. And we'll just have to see how things go. Now, U.S. Steel had good results, not Wheaton. Where's Walgreens? We don't have Walgreens in the long-term portfolio? Oh, that pisses me off. IBM just had very nice results. We have a couple of IBMs, I think. Yeah, we have two different IBM plays. They just had very good results. They're $10. That's nice. We'll see. And we'll see how Cleveland Cliffs also, because of Biden's new policy, also had good news basically, but they're already so deep in the money we don't really care. Boyd Gaming had good news recently. Don't have a big loss. Boeing just got a really good write-up from analysts. Apollo is one of the people screwing people out of money on the real estate ventures. So, like I said, though, we invest in these things. That's the thing. You know, it's like it's horrible. It's destroying society. It's making an unpleasant planet for the human, you know, for the population, other than the top 1%. But you know, hey, that's what we buy. You just got to look at the trends and be like, okay, this is how things are going to go. So what else did we talk about today? So at the moment, it's a lot of watching and waiting to see where we're going to be. Netflix, we talked about that already. It was you know, the key chart for Netflix for me is this. They've already got 221 million subscribers. HBO has been around for 1,000 years, and they've got 73 million. So these are global, by the way. Then you add, these are the US. Wait, no, sorry. These are the US. And I'm pretty sure, unless HBO is different than HBO Max, I know HBO has over 100 million people, so it doesn't make so. It only makes sense if this US number is not the. These global numbers are not including the US, I think. But either way, the king is Netflix. However you want to slice it. I mean, the 221 is their global number, including the US, as far as I know. I don't know. It's weird. I fairly positive that HBO has more than 100 million subscribers, so I'm not sure where this comes from, unless they're talking about it being a streaming service, HBO Max, versus home box office, which is a cable thing. That might be why. Anyway, you see the discrepancy here, though. I mean, Netflix owns this market. Amazon is misleading, because if you are a Amazon Prime subscriber, you know, Amazon Prime, the delivery service, which, you know, frankly, anybody who buys anything, anybody who has money, anybody in the top 50%, top 40%, you know, if you buy more than $100 worth of stuff on Amazon, you can pretty much justify getting a Prime subscription. Free shipping. You know, free shipping is free shipping. It's going to save you if you buy from Amazon 10 times, it pays for it. So it's almost no reason not to. Then it includes Prime Video and a couple of other things that they include in there also. So it's kind of cheating because they give it away. It's free. So, you know, I mean, I guess you can subscribe to it as a separate service, but they basically give Amazon Prime Video away to everybody who already bought Amazon Prime anyway. So it's not like they earn those subscriptions. And like I said earlier, Disney is Disney. I mean, if you have children, hey, good luck explaining to them why they can't have Disney. HBO, and after that, you've got also-rans. Once you get past HBO, you're into the also-rans. You know, even Apple, I mean, this is good. They're only just starting out with Apple. And Paramount Plus 2 is only just starting out. But there are, you know, it'll take many, many years to get up to these kind of levels, if they ever do. And then you wonder how people even afford it, though. Because, you know, let's say you have 15 each. You got 15, 15, 30, 60, 90, 120. Here's $120 worth of streaming services that, you know, we used to pay $20 a month for cable. So you talk about inflation. You used to get HBO and everything else for $20 a month in cable TV. And now each one of these things is, this group would set you back $120, and you don't even have network television. So that's a little kooky too. But I think the statistic is that Netflix represents almost 30% of all web traffic now. I think the rest is Pornhub. But Netflix, I mean, not streaming traffic. I mean, Netflix is 30% of all traffic on the internet is somebody watching something on Netflix. That's pretty amazing. And YouTube's a big chunk also, but not as big as Netflix. So that's what we did with the internet. We didn't split, you know, we didn't invent fusion. We didn't do a lot of things that we were supposed to do with the internet. We didn't increase the knowledge of the world. We didn't bring peace and prosperity to all the corners. We haven't improved farming and manufacturing in third world countries. No. We've got, you know, we've got all these stupid shows that everybody sits down and watches instead of working. It really is crazy. I mean, it's a poorly planned planet, and so, you know, you look at the rise of fascism, and I guess to some extent I can understand where people feel that things are so wrong that you need a leader who's going to tell you what to do and make things right. You know, but I don't think that's going to really work either. I think that's, you know, idealistically, if you imagine that this leader is some benevolent soul, but certainly the people that they pick to be the fascist leaders are not the type of people who you want to be, ruling you with an iron fist. Who pulls that off? Not Xi, not Putin. It's, you don't feel like the benevolence is coming through there. You got Trump. Who's Le Pen now? This is why in France they're having the election tomorrow. I don't know, like this week anyway. And France may go with the fascist leader. Hungary, as I think people know by now, has gone fascist completely. It's interesting. But the France thing is a big deal because it can pull NATO apart. This is another yanking of not just NATO but the European Union. They don't want any of that shit. Le Pen is like Trump on steroids. She wants to throw out all the immigrants. She wants to close France's borders. She wants them out of the EU. They want to just do their own thing. It's very scary what's going on in the world, because this is how you end up with wars. Well, more wars. We already have wars. Here's IBM really popping now, looking good. Walgreens still moving along. That's good. Oh, wait, what's that? Oh, that's just EU passenger car registrations. Yeah, meanwhile, there's clear indications. EU passenger car registrations, what were they down? 20%? 20% in March. That's a lot. Now, don't forget, March is a longer month than April. March has 3 more days. 10%. March has 10% more days than April. Yet there were 20% less registrations. I'm sorry, than February. I mean, that's a very, very bad sell-off. Led by Italy, 24%. France, 17, Spain, Germany, question mark. I don't know what that means. Whatever Stellantis says, they had a really bad month. Toyota, Volvo got crushed, Nissan got crushed. Mazda held up pretty well, but that's because nobody actually drives a Mazda anymore, as far as I know. What's the Fed saying? The Fed's talking, 2.5. The Fed's 2.5% is the low side, and now we're talking 2.5% plus is the general Fed thing. Evans is saying 50 basis point hike in May, and apparently, look, the market doesn't care. They're floating these things. That's every single speaker from the Fed in the last couple of weeks has been talking about more rate hikes. You know why? Because they look at the market and they say, well, you didn't care last time. We just had a meeting like 2 weeks ago, and the market barely fell. Well, this is not daily. All right, so we just had a meeting here, and the market didn't fall. And if you don't care about that, then we'd like to raise our base. We want to raise our rates as fast as we possibly can. Clearly, the pace we're telling you doesn't bother you. So how about this? And that's what they're doing now. Now they're trying higher numbers. They're like, how about this? How about that? Because if the Fed can't lower rates, then what happens if there's a problem? What if the war breaks out? What if there's another resurgence of COVID, so on and so forth? If the Fed hasn't got room to lower rates, they have no firepower, and they can't do anything. They can't step in. So they're ineffective policy on the downside, and everybody knows there's going to be a recession coming, even if everything else goes okay. Even if the COVID goes away and the war goes away, they're still going to have a recession. So the faster the Fed can raise rates, it's like loading their gun. They got to load their gun up for the next time they have to use it. So they want to raise rates as quickly as possible, and if the market is going to be like, I don't care, then they're going to keep doing it. And that's why they keep making these comments. Where are we? Oh yeah. Yeah, Rio Tinto, they missed their production targets, but basically, It's just normal stuff, though. It's, I mean, what do you expect with everything that's going on? Jeffrey suddenly doesn't like Chinese casinos. The oil inventories were surprisingly, oh, again, let's look at that. What happened there? Petroleum status. So what happened? U.S. crude imports, blah, blah, blah. U.S. refinery imports, blah, blah, blah. Commercial crude inventories decreased by 8 million barrels. All right. What the hell? Oh, there they go. You know how it's always here. It's always here. We exported. We look at these exports going up. Last year we exported 2.4 million barrels of petroleum. Now we're exporting 4.2 million barrels. 441. Wait, it's not, none of the numbers right. 4182 minus 2424 is 1761 divided by 2424. 72% more. We're exporting 72% more oil than last year, but more importantly, what was that number? 1.7. So it's 1.7 million barrels per day times 7 days. We're exporting 11.9 million barrels a week more oil than we did last year. That's insane. That is just flat out nuts. So that's where the oil is going. From the Strategic Petroleum Reserve, only 4 million barrels were released. I don't understand how they're ever going to release 60 million barrels if they're doing 4 million a week. It's going to take forever. So we've released 4 million barrels from the Strategic Petroleum Reserve. All other oils went up 4 million barrels, so that wiped out that. And we exported more. Well, now we only exported though 200,000 more per day. So that's 1.4 million for the week. So 1.4 million was export, and the rest went where? That's pretty freaking weird. Where did the oil go? I don't see it. Crude oil to refineries, 1.5, 1.8, same. Refinery utilization, same. Motor gasoline, same. Distilled production, same. We got crude oil had a big drawer, obviously, we know that, it said that. Motor gasoline had a little drawer. Distillates had a 2.5 million barrel drawer, we know that. All other oils went up. SPR went down 4 million barrels. We exported 395,418 is 200,000 a day. That's not that much. That's 1.4 million extra was exported. I guess it's oh, here it is. So look at that. See that? There it is. So you got to find it. We imported less too. So that's imports, and this is negative imports, and that's positive imports. So we imported less, 200,000 less. So that's 1.4 million there. So we imported 1.4 million less, and we exported 1.4 million more. That's 3 million now net that we sent out. Otherwise, though, motor gasoline made the same amount of motor gasoline, made the same amount of distillates, basically, made less all other oils. We made less by 400,000 a day. That's a lot. That's 2.8 million barrels. So we made 2.8 million barrels less of all other oils, even though we're sending all other oils out at an incredible pace. It doesn't really, it's very jumbly. There's no particular thing to point to here. And they're going to call it demand, but this ended April 15th, and we just had the holiday. So I have to believe that this was a lot of people tanking up ahead of Easter. You know, and also the prices came down a little bit. So a lot of people might have tanked up and caused a demand surge, but then that'll probably get made up. Like next week, there'll be less or something like that. We'll see what happens. But there's nothing very conclusive to all that. See if any questions or anything. Robin says FNF has a PE of 5 and a 4% dividend. I don't know how to find the debt load to see if I wanted to invest. Fidelity National Financial is a very good company. I used to work in that industry. And rising rates should be really good for these guys because they are primarily a title insurance company. And so they're very heavily restricted in what they can do with their money, but they have tremendous cash reserves. Because what they're doing is they're ensuring that you have adequate title to your home. So when you buy a home, you get title insurance, and you make sure that they insure you that nobody's going to come along later and say the deed was faulty or so on and so forth. Of course, they do research to make sure that they feel comfortable that the home is not faulty. There's an incredibly low default rate in title insurance. Not even 1%. I mean, not even 1 out of 100 homes. It's 1 out of 1,000 homes almost that something like that might happen. And even then, it's usually something that can be fixed, so it doesn't cost them the whole home. But meanwhile, they charge you 1.5% per home, so they make a fortune. But the government requires them, since they do this based on their maximum risk, the government requires them to hold their loan loss reserves into very, very ultra safe accounts. So they're kind of trapped into regular bonds and things like that. They don't get a lot of high yield investments. So as rates go up, it's fantastic for these guys. So there's that. You were concerned about the debt, the PE ratio of FNF. By the way, when in 2008 here, when FNF was down here at like $10 or whatever it was $2 billion for the whole company. I tried to buy the company. I literally was trying to put together a team of people to buy the company. This was, of all the things I wanted in the whole world, I wanted this company. Oh, also I knew people in the industry, so that was part of the reason that I knew that, for trying to find people who had money. But I was trying to buy the entire company for $2 billion at the time because it was ridiculous. It was just, it was, again, based on what I'm saying. It's just you don't understand how this company works. Nothing is wrong with this company. And real estate, they're involved in real estate, so they crashed out with everything. But meanwhile, the way they're involved in real estate had nothing to do with what was happening in the market. They could care less what the price of the property is. So no skin off their back. They only care if the title was transferred correctly. Anyhow, so my guess is they don't have any real debt, but let's see what it says. How are they doing? They're doing good, right? Yeah, they're making, back in the day. Now they're making like $2 billion. Now they make $2 billion a year. That's pretty freaking good. Balance sheet. So net debt. Yeah, see, negative net debt. There's no reason for them to have debt. They're just a money machine. They just spit out cash, and these rising rates are going to kickstart those numbers to a much better level. They've got incredible loan loss reserves, like wild amounts of money sitting in cash. I mean, in notes, basically. So I like them. It's a good suggestion, and we should follow through and make that a trade. Okay, so let's guys try to remind me that in chat, because that's something I definitely would like to do. Fidelity National is basically a no-brainer of a stock to invest in. And it's a little bit of a pullback, but nothing significant. But we could put something together. And Robin, in case you're not, let's see. Oh, that's why we don't trade them. Shit. God damn. They only have options until December. That's really annoying. All right, but still, look at these prices. I mean, it's a quickie trade. You could buy the stock for $43. You can sell these calls for $5.50, right? The 40 calls for $5.50. So we got, let's see. So we got 43.21. We buy the stock for. Minus 5.50. We sell the $40 calls. That's 37.31. And we sell the $40 puts for $2.80. So minus 2.80. So now we bought the stock for $34.91 net, right? We could be assigned another round at 40, but that would only average us at what, 75. So 37.50. So the worst case would be owning it for 37.50, which is $6 lower than it is now, which is almost 15% below the current price. Plus the dividends come, and the dividends are going to be here it is. Nope. So the dividends are $1.75. So when is the next dividend? Ex-dividend March 16th. So they just paid their first quarter. So you have 3 dividends coming, which is whatever that is. So this historical data. La 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 la. 44 cents. So whatever that is $1.20 and 12,132. So minus 1.32 in dividends is 33.59. So you're netting in. So in other words, you're buying the stock, Fidelity. You're selling the $40 puts and calls for December, and you're collecting the dividends or anticipating collecting the dividends. So it's going to be 33.59 in, and divided by, minus 40, because you're going to get called away at 40, 641, divided by 33.59, I said. 20%. So between now and December, not even January, between now and December, you will make 20%. That's good money. There you go. You're Elon Musk, right? What did I just say? Elon Musk is looking for 10%. You make 20%. You can go to Elon and say, hey, I got a deal. And you know what happens though? He'll come in, he'll buy it, and he'll take it away from you. There won't be any left for you. All right. So that's why we don't have Fidelity in our portfolio. It's a fantastic stock, but it doesn't have great options. And by the way, I imagine everybody here's a member, so I guess it doesn't matter. But I mean, you know, for PSW, that's not a very exciting play, frankly. But it's, you know, we make a lot more money than that in a year. But it's a nice, safe thing to do, and it's a great way to invest your money. There's nothing wrong with that at all. I mean, that's a good, reliable place to put money. So who's the other ones? First American. F First American IS. No, that's Fidelity Information. First FAF. First American is another big one, big title company. 61.68, also ridiculously low P. They're probably in the same general position. Let's see how far out options go on these guys. Nope, same shit. No better, only options till October. That's a shame. Old Republic is ORI, right? Nope. Are they no longer public? ORI, they are ORI. Did I type something wrong? ORI. Oh, there they are. Old Republic, same thing. All these is interesting. All these title companies have really crappy option strings. But yeah, and nothing wrong with owning those guys for the long term and just treating them like a regular dividend stock. But my attitude is if you can amp up your dividend return from 5% to 20% by selling the options, why not? Right? And you don't have to look at it. Let's go back to First American. I mean, to Fidelity. What? What am I doing? Oh, God. It was FNF, wasn't it? Yeah. How weird. FNF. Oh, I see. If you don't, it gives you all wrong choices, but then if you actually just hit it, it goes. Oh, I think going back to the example. So let's say, look, if you buy the stock for 43 and you just take the interest, okay, you're just hoping it stays at the price it is and collect the interest. Fine. Why should you though? All right. The way we did it. So in other words, even if you bought half as much stock, right? Because all you're going to make, if you buy it at 43.20, yes, it could go up a bit, but if you buy it at 43.20, all you're making is the $1.75. Oh, it's not even $1.70 for the year, but it's $1.30, let's say. So you're going to make your $1.30 in interest in dividend, but that's it. And then maybe you'll make money on the stock. The way we're doing it is we're lowballing it, so we're protecting ourselves because it's 43 now. It could drop almost 10%. It doesn't hurt us. So we sell the calls, we sell the puts, all right, and we go from 43.20 minus, what did we say, 550, 550 minus, because these are facts, minus 275 minus, let's say 270. So we're dropping our net to $35 from 43. That's $8. Okay, and we're going to collect the same dividend. So let's not even put the dividend. The dividend's out of the picture. We're going to collect the same dividend because we're buying the stock, selling calls against the stock, and selling puts. Definitely collecting the same dividend. But we're also going to make $5 from 35 to 40. At 40, you lose money. At 41, at 42, at 43, you lose money. You don't make money unless it goes $5. You're not going to make $5 unless it goes $5 over 43. That's go to 48 for you to make $5. We're making $5 at 40, which is below the current price. There's no disadvantage to doing it this way, and there's many advantages, especially that we have a very, very clear shot of making 20%. The outside chance that you make more than 20%, that the stock goes up more than $8, then you'll get your dividends and you'll make your money. Okay, that's always a possibility, but we have a probability. I'd rather have a probability than a possibility. And that's why we like to do it that way. And since we're going to make so much more money, you could buy half as much stock and probably make the same amount of money. And that way you don't have the risk of the assignment, because your biggest risk here is that you're going to be assigned another batch of stock, that more so than you started with. So if you start out with a smaller amount, you mitigate that issue. But our goal on a dividend stock like this is that we net out of the stock for 35. We're net 35 after in December. We've already knocked our net down $8. That's 20%. If the next 4 years we keep knocking 20% off the net price of the stock, then we end up with owning the stock for free, and we're still getting dividends. Whereas you would most likely still be sitting on the stock at the same $40 it always is. So that's why we like that better. And where's that long-term thing? Here's the big charts. So it's not worse. The worst thing is we end up having 2 times what we started with as an assignment, but then just start with a lower amount if that's going to bother you. But as you can see, if we go to max, okay, it's not a very volatile stock in the long term. In the short term, it's very volatile. That's why I like it. It's kind of fun to play because of that. But in the very long term, it kind of steadily goes up. And this rising rate environment, I'm pretty sure it's going to be great for them. The way they invest their money and the way they keep their cash reserves, this should be a great environment for Fidelity. Okay. Oh, okay. We got a few more minutes. I gotta go get on a business call. What else do we want to talk about? Not much. Honestly, it's not. I mean, at the moment, we're just watching and waiting for earnings. Let's take a look at who's got earnings coming up. Twitter. There's Twitter. Earnings whispers. These are the guys. Not that, not that, not that, not that. Oh, come on. There it is. No, that's only the week. Here we go. That's what's coming up. So, I mean, you got to trust them to pick out the stocks that matter. But so tomorrow we got Tesla, which will be interesting. Alcoa, PG, United Airlines, Abbott. I can't tell what that is. Then we have American Airlines tomorrow, and AT&T, of course, we're very interested in because we have AT&T in basically all of our portfolios. We have Dow. Here's Cleveland Cliffs over here. Here's Verizon. Here's American Express. Next week, Coke, Activision. That's the big Reddit thing right now. Here's Microsoft and Alphabet on the same day, and then Apple must be around here somewhere. There's Apple. Here's Facebook. So the thing about Netflix is, don't forget FANG, right? So it's Facebook, Apple, Netflix, Google, Amazon. Oh yes, Facebook, Apple. There's two A's. So it's Facebook, which is now Meta. Apple, Amazon. So FANG is Facebook. Where'd they go? So Facebook, Amazon, Apple, Netflix, who just went, and wait a minute, Google, Alphabet. There, Alphabet. Somehow Microsoft didn't get themselves included in that. So Netflix disaster. Does Netflix reflect on FANG? Well, Google's growth is the same kind of problem. Amazon's growth is the same kind of problem. Amazon has the same amount of subscribers as Netflix, so how are they going to grow faster? You may get the same kind of knock from Amazon you got from Netflix about the subscriber base, and so on and so forth. Facebook, I think they're at a stage right now where they're spending a lot of money on this metaverse shit, and they're not going to get any return out of it, and that's normal. Obviously, you can't build the metaverse without spending money, and you're not going to immediately populate it and get your money back. The question is, are people going to put up with that in their report? And also, like Netflix, they reach peak subscribers. They reach peak people sitting on their asses staring at Facebook all day during the pandemic. How are they going to grow from that? How is anybody growing from that? Okay, Google has their advertising money, but again, they already have the whole world. It's hard to grow when you have the whole world already. Microsoft, they're a cash monster. They've got the cash flow, their subscription model. They don't really spend a lot of money innovating, do they? I mean, Microsoft just keeps updating Windows and whatever, and updating their software suites. They're doing their cloud services, but they're not like throwing out a lot of new shit. That'll be interesting. So this is a very dangerous time, but once we get past this, then the Nasdaq is pretty safe. But this murderer's row here, 3 days next week, is going to be crazy, because this could turn very, very ugly for the Nasdaq. It's hard to see how it's going to be all positive, but it could turn really ugly. Got Boeing next week. We got Qualcomm. We got a lot of exciting earnings coming up, actually. Intel. Love Intel. Caterpillar's an important one. We'll see. Oh, that's going to be interesting to see how they're doing through all this shit. Exxon with the incredible oil prices. How could they have had a bad quarter? How could they possibly, all the oil companies next Friday, how could they possibly not be raking in the money? They're selling the same freaking oil for much more money. I can't see how, because demand didn't suffer, right? So I can't see how this is not going to be great for that. But question is going forward, what are they saying? Because now their costs are going up for sure. And you know what's interesting? Exxon is hinged on refining. Valero, by the way, where was Valero? I don't know where they were, but they just reported really astounding numbers. So Valero had incredible numbers because of the spread of what they charge between the oil and the gasoline. And we talked about that. I don't know if it was here or in chat, but we talked about it last week on how Valero has this crack spread. It's, that's how they make their money. So Valero had great money. Exxon has different segments, and one of their big refining segment also. So I think Exxon should do very well. Chevron sells a lot of natural gas. They should do phenomenally well. Phillips is very refining oriented. They should do well. So this should be a really good week. This should be a good finish to the week for the S&P, bringing things up. But the question is, what happens to the Nasdaq next week? That's going to be the big question looking ahead. So we'll see how that goes. And then Pfizer, it's hard to imagine. Pfizer's going to guide with COVID to see how things are going to go this year, because Pfizer acts not profiteering so much. They accidentally made incredible amounts of money. Just because they came up with a vaccine that everybody in the world wanted, so they sold vaccines to everyone in the world for incredible amounts of money. And honestly, I don't think they weren't gouging anybody, I don't think, but I mean, what are you going to do? It's 100, you're selling these vaccines, the shots are maybe $50 and maybe $10, 20% is profit for them. The rest is distribution and everything else, not to mention the R&D they put into it. It wasn't terribly unfair. I know a lot of people scream they should be giving it away and blah, 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 but what good does that really do? To some extent, there has to be reward for coming up with these things. Otherwise, you're not going to get the race that went on with everybody spending, all these independent companies spending billions and billions of dollars to develop this vaccine, because there was a reward for it. If you take away the reward, next time you have a pandemic, you're going to have to pay the companies to do the R&D, because they won't do it, without knowing they're going to get their money back. So that was fair enough. But anyway, so we will see what happens, but there's plenty of interesting things. And once we lay a base down, then we can start looking at people and say, well, this one's like that one and that one's like that one. But right now we don't have enough information to go on. All we have so far right now is this was a disaster. IBM services, cloud, home run out of the park. No problem there. Like I said, Valero, we already know, came in good. We'll see how some of these other guys do. Well, there's so few things to go on so far that everything else would be a guess. So right now we're kind of in a watch and wait mode, and we'll see what happens. All right, so that's all I got time for right now, and we'll do this again next week. All right, thanks everybody.